Bitcoin is going to hundreds of millions of dollars per coin. And I really believe this. And I know there's a lot of moving parts in the world and things can be very confusing to people. But in this video, I'm going to do my absolute best to break it down as simply and succinctly as I can. Now, there's a lot of moving parts here, and there's a lot of questions people have about the financial universe in general right now, as well as about Bitcoin in particular. People are always wondering, why is it that it feels like housing is getting more and more expensive? Why is it that all the Bitcoin nerds like myself happen to think that Bitcoin is going to be one of our greatest tools at preventing a future world war? What is the Bitcoin difficulty adjustment? Why does that matter? What can we learn about from history when it comes to understanding the stock market, the bond market, the real estate market, gold, and macro cycles between back and forth commodities and securities and debt? Where are we on the big debt cycle? And ultimately, what does it mean for you? Well, what it means for you, all this stuff we're going to go through in today's video may sound big picture and all that, but we're trying to make it as understandable as possible because all of our brain, you hear in all the news media, you hear all over social media, all these theories and all these kinds of concepts, but really what people are doing is they're trying to take small snippets of the big picture and project forwards in the future. When what you need to be doing is taking a breath and zooming out and asking the first principles questions. Before we can discuss why Bitcoin is going to $100 million, first we have to understand why Bitcoin is superior money. But before we can understand why Bitcoin is superior money, we have to understand what the purpose of money is in the first place. And before we can even get to understanding what the purpose of money is in the first place, and therefore identifying what is good money, and therefore identifying Bitcoin as the superior money, first, before anything else, we have to ask a simple question. What makes all this go around? What makes the economy, what makes the financial system, the banking system, every market in the world, including Bitcoin, what makes it tick? What makes it work? Well, it's a spectrum of value, and that's where we're going to start in today's video. So we're going to make a spectrum here. We're going to make a spectrum, a line spectrum here. It's not a straight line, but that's okay. So we're going to have on one end, we're going to have commodities, and on the other end, we're going to have debts and financial instruments. So this is something a lot of people talk about with intrinsic value, right? People say, oh, Bitcoin doesn't have intrinsic value or whatever, right? And therefore it's a scam. How could it be the world's perfect money or whatever? But what they're forgetting to understand is that whatever criticism they have of Bitcoin saying it's not intrinsic value, the same thing is true with gold. The same thing is true with stocks. It's true with bonds. It's true with basically everything else you can't eat. And so you have to be looking at things on one end as something with intrinsic value, survival value, utility value. And on the other end of the spectrum, you have to be looking at something from a monetary premium perspective. So way over here on this end of the utility to monetary spectrum, you have oxygen. You have O2, right? You have oxygen, right? I am using oxygen, speaking to you right now. You're not even thinking about it, but you're breathing in oxygen right now. Now, oxygen is something that is the thing that is the most baseline utility commodity in the world. Oxygen is more important than water. It's more important than shelter. It's more important than weapons. It's more important than everything else in the world, right? Nobody dies within a couple minutes if the bond market fails, or if Bitcoin fails, or if gold fails, or if oil fails, or anything else. If you take oxygen away from a person, literally within 30 seconds, they're going to be desperate for whatever case to get that oxygen back. And within a couple minutes, they would no longer be with us here on Earth. Now, on the opposite end of the spectrum, we have Bitcoin. And before we get there, before we begin explaining why Bitcoin is going to hundreds of millions of dollars a coin, first, we got to progress through all this so that then we can understand that. So we have oxygen on this far end of the spectrum. Then we have water. We have H2O, right? We have water, right? Because water, of course, is something else that's essential for life, right? Then we have food after that. And then maybe we have weapons to protect the food, to protect housing, to protect ourselves, right? Housing is also somewhere in there, right? And my point is we go on and on and on, and eventually we reach a different part of the spectrum where we're getting to more and more indirect or intangible forms of economic purchasing power, right? Let's say, here we have gasoline, right? Let's say we have gas, right? Sure, gas, I can't breathe gas, or at least you shouldn't. You can't drink gas, or at least you shouldn't. You can't live in it. You can't protect yourself with it, right? But gas has some value. Sure, it has value on this end towards more building of a society, right? Like gas is really important for making cars go, for giving you transportation. And that transportation helps you go to work, get an income, go to the grocery, to buy the food that you need to live, right? So, we're moving towards a spectrum here where sure, it's not quite as intrinsic for your baseline survival. It has a bit more of a monetary premium. However, it's something that is still worthwhile. Beyond that, you get to the main kinds of asset classes. You get to stocks, you get to bonds, you get to gold, and you get to USD, right? You get to political currency units. And my point in giving a spectrum here is that a lot of people say something does or does not have value purely based upon their human biological brain determining if I can eat it or if I can drink it or whatever, right? But all these things have value. They just have different kinds of value. You have never spent any money for any oxygen ever in your life, most likely. If you are a human here breathing on Earth, you haven't, right? But yet it's still more important from a utilitarian perspective than literally everything else in the world. On the opposite end of the spectrum, you can't eat stocks, you can't drink bonds, you can't live in a bar of gold, and the same thing's true with dollars and Bitcoin, but these things still have value, right? Maybe they don't have utilitarian value, right? But they have a monetary kind of value. And my point is, on the spectrum, in general, what you can think of this as is that in a world that's less technologically advanced, you need things more on this end of the spectrum. And in a world that is more technologically advanced with more technology, more culture, more complexity in culture, a greater division of labor, as you progress throughout history and time, you get to desiring to own more and more of these things. The farther back in time you go, in general, the better idea it is to own these assets. And the farther into the future you go, it is a better idea to own these assets. So what does this concept have to do with the big cycles of history and financial markets? What does this have to do with the inherent conflict that's facing us here in the 21st century? And ultimately, why is Bitcoin a solution to this problem? Well, it's because we have this spectrum of value, and historical cycles ebb and flow back between these periods, right? So let's go, I'll just add to it a little bit. So let's say that we're traveling back in time, right? Imagine yourself going back in time. Okay, these things are the things you want to own. Why? Because these things are more scarce, these things are more finite than these, right? If you're in the ancient world, you don't need to own a stock or a bond or a bar of gold or even Bitcoin for that matter. You want to have food, you want to have water, you want to have shelter, you want to have weapons to protect yourself, you want to have land to grow your crops, right? You want those commodities out there, right? You don't want to own securities of companies that don't exist. You want to own the underlying commodities, right? This end of the spectrum is monetary premium. This is debt. Hard to write sideways there, right? That's debt. And then this end of the spectrum are commodities and utility. Utility, commodities. So we have commodities, survival, and we have, culture, technology on this end of the spectrum. And so if we're back in time where the thing that is scarce is survival and not necessarily planning for the future, right? This also has to do with time preference. These are low time preference kinds of commodities. These are this is high time preference. By high time preference, we mean it's high frequency, just like with like a microwave being a low frequency, an ultraviolet wave being a high frequency. These are high time preference kinds of assets to own, meaning you own, you buy groceries for the next week to survive for the next week. On this end of the spectrum, these are low time preference assets because the frequency that you're vibrating on, so to speak, on this end is much more like a microwave than that of a gamma ray or visible light or something, right? This end, you buy stocks and bonds and investment grade real estate and Bitcoin for the next 10 years, 20 years, 50 years, right? This solves your needs for the next hours, days, weeks, months. This solves your needs for the next years, decades, generations, and potentially even centuries if you're a long-term kind of government or institution or church or something, right? So where do the big cycles in history play when it comes to this spectrum? Well, if you go into periods of relative scarcity where assets are rare and survival is really important and it's hard for people to get by, well then you have this being really finite, where there is a massive amount of premium, there's a massive amount of markup for these kinds of things, and there's really not a lot of markup down here, right? One of the examples I'm going to be referring to throughout this entire video is that of the Dutch, because the Dutch are one of the best examples of this. They were not the first example in history, and they are certainly not the last. We're in a cycle right now when it comes to this, but I think they were a good example because the Dutch were one of the first really global European empires. They had the first stock market, they had the first central bank, and they had one of the most well-documented financial blowups of the entirety of European history. So I'm going to refer to them a lot. So let's say we're at the beginning of our big cycle here. So if we look at the cycle, let's say we have a cycle starting out, and we have a rise up, and then a decline down, and then we have another cycle up, right? If you think of history in these kinds of long-term cycles, in these periods where we have drawdowns, you have a markup of commodities because the financial system is having trouble. People need to put food on the table, they need housing, they need those kinds of things, right? So down here, we are in periods where there are a lot of commodities. You don't want to own the debt of companies that are going bankrupt. You want to own the underlying commodities that help survival, right? And here in these up periods, here in these peak periods, when technology is at its furthest and society is at its furthest and the government has the greatest amount of premium ascribed to it, that's where you have a greater end on this, right? We go from survival to overabundance to survival to overabundance, right? Now, hopefully, Lord willing, and we hope and pray that over time, despite cycles of debt expansion and contraction, we hope that each time we're making some kind of progress, right? But if we go back to the Dutch at the beginning, let's say this is the 1400s. Whoops. Let's say that this is the 1400s over here. And I'm rounding a lot here. And let's say this is 1800 and the Dutch Golden Age of 1600, right? My point is, let's now put a practical application to this. At the beginning, before the domination that the Dutch had of the world, spices were rare. It took a lot of energy to get spices, right? You and I today, way over here, centuries later, you and I have a lot of spices that we take for granted. And when we go out to a restaurant, when we are, looking through our pantry, right? We have a lot of spices, we have a lot of flavors that we can add to our food. But before the Dutch Golden Age, this was something that was very, very rare. You had to travel across the world. You had to go to India or Africa or the Middle East or wherever to get spices. You had to transport it back. It was very expensive. It was reserved for royalty. And spices are on this end of the spectrum. Spices are commodities. Spices are not securities. And so commodities were very rare. There wasn't a lot of corporate value at creating these spices because the companies didn't exist because there weren't, the spices weren't being mass produced, right? So what happens? Well, you have the free market do its thing. The free market builds with more technology, more innovation, and more progress, the division of labor. Then you have the Dutch invent the first stock market, meaning that people can actually securitize and issue and distribute in a global high-frequency manner, in a very rapid period of iteration. People can move capital around, they can move investment, and the Dutch, basically took over global trade for a very long period of time. They were trading with the Japanese, they were trading over in Asia, they were trading in Indonesia, South Africa, all across Europe, right? They literally had their entire empire rise to power because they harvested energy. They took energy from the air, right? They took it in the form of wind, and they converted it via windmills into building more land for themselves, right? They literally harvested the commodity of energy, of movement, kinetic energy from the air, and drained much of their swamplands. Much of their country is below sea level, right? And so they literally gained more land, right? You gain more land, you gain more land for your sheep, you gain more land for your livestock, right? The livestock themselves are a commodity, right? You have a growing abundance of commodities. The Dutch have more land. They have greater ability to cut timber, right? They went from needing 3 months to build a ship to only taking 3 weeks, because instead of having 20 men with 20 different saws, spending, 200 hours or something, sawing on a log, they could use one single windmill to do the work of 20 men in, a 50th the time or whatever, right? So with more lumber, with more land, with more sheep, with more food, with more housing, therefore, and everything else, you have an abundance of these things. And with an abundance of these things, you don't want to own things on this end of the spectrum, right? If you were here at the beginning of the Dutch Empire, you don't want to hoard timber. You don't want to hoard logs, because ultimately what's going to happen is that if you believe in the long-term future of humanity in general, or just specifically your country, right? If you believe in the long-term trajectory, well, then you should expect that, hey, we're going to make more land. We're going to make more waterfront property. We're going to make more wood. We're going to make more food. We're going to make more housing. we're going to make more of everything, right? And eventually you get going on this direction a little bit, right? Then you get to diamonds, then you get to exotic chocolates, then you get to spices, then you get to other things, right? You go from the bare essentials of land and food and water and basic transportation to then dominating, commodities that are less essential for living, right? Like jewelry and diamonds, right? The Dutch were very famous for their diamonds, right? As they went on into the future, right? And of course, spices being the very famous one. Well, they're famous for many things, but spices are the ones that we're going to be talking about here. So you have spices, they're on the commodity end of the spectrum. Spices, they're not as essential as water and oxygen, but, they are their assets, right? You can own, the spice, right? You can have it in your pocket. You can have it, on your person, right? Unlike a number on a screen, whether that number is a security like a stock, or it's a debt like bonds, or it's a digital number like Bitcoin, which we'll get to later. But the point is, you have spices that are rare. And so what do? You securitize a company like the Dutch East India Company. And then that company goes out in the world. They go out into the free market. They go out and trade, conquer some people, enslave some people, whatever. Sure, all that. We'll gloss over that for now for the sake of the story here. But theoretically, through the free market, through competition, through technology, they go out in the world and they produce more of that commodity, which people are in need for, because there's a massive premium. Like, hey, we don't have enough land. Let's go build more land. Hey, we don't have enough ships. It takes us 3 months to build a ship. Let's build a ship faster. Hey, we don't have enough spices. We will pay you. We will pay you other commodities. We'll pay you other things of value that we have excess of to buy the thing that we have a shortage of. We will give you more things you want to get the things we want, because there's a massive premium to these spices. And so what happens? Well, you have the corporation, you have the stock market, you have the government being able to raise more taxes, right? As more productivity happens first, then governments are able to raise more in taxes. When the people don't have wealth, you can't raise taxes, right? You need to have the people have wealth, and the people need to have the desire to stay in your jurisdiction in order for you to raise the taxes to continue to fund your military and continue to fund the interest payments on your debt. And so it's a balloon that continues to expand and expand and expand. The more productivity you have, the more wealth you have, the more excess wealth you have, the more the government can tax. The more government can tax, the more they can raise bonds. Bonds are just the government's ability to raise capital, raise money from people that they have in excess for the future. Instead of people needing money and being, proverbial, hand to mouth, paycheck to paycheck, now people have some excess capital. Well, what can they do? They can give it to a company in the form of a stock, and that company can go out in the world and raise cash flows, sell things at the premium, right? And then they can return some of that premium back to people because they're saving for the future. Or if they have an even longer time preference, they can go to the government and give them a lump sum of cash, give them a lump sum of that excess premium that they have. Now that they are extending their time horizon, they can give it to the government and say, hey, government, I will give you, 100 currency units worth of money if you give me, 3 currency units worth of, interest every year or whatever, right? So, it's an abstraction of an abstraction. These things have real value, they have real wealth, but it's all built upon the premise of commodities, of people having enough to eat and survive in the short-term high frequency, that they can extend that time horizon to the longest frequency possible. And so what happens? Well, we start out with a society that has a baseline in commodities, in survival, in these kinds of things. And time progresses, and we have microcycles within cycles, right? Every couple of years, there are different cycles, maybe some of them go up and down, right? But there's a lot of volatility within this, right? We're just zooming out to the big picture. But what's the ultimate problem that happens in here? Well, here's the problem. What is the ultimate commodity that preserves its purchasing power without being diluted more, right? You don't want to store your purchasing power in oxygen, because trees will make more oxygen for free for you, right? You don't want to store your purchasing power in oxygen. You don't really want to store it in water either, because that's also pretty abundant in the world, right? It literally falls from the sky, every so often, especially if you're in, Northern Europe, right? You don't want to hold your purchasing power in water, even though there's a dramatic utility value and people will pay you literally everything else in their life just to get a bottle of water if they are thirsty enough. You don't want to hold your purchasing power in that. And so what's the commodity? What's the thing that's not something somebody can print out of thin air? What's the thing that one can own that is the hardest to dilute, the hardest to distribute? Well, diamonds are in there, right? We talked about diamonds. Rare spices, maybe if you're in Europe, 400, 500 years ago. But also we have gold. Now, I know I also wrote gold over here, but there's different purposes of gold, right? There's gold, you can think of it like a commodity. You can also think of it as, you know, it is less utilitarian than everything else I'm mentioning, right? So my point is, in that cycle, we start out with gold. We start out with gold. I'll use consistent colors here as to not confuse myself or to confuse you any more than I possibly am. So we have gold. This is the bedrock. We have gold, GLD, as the bedrock for the financial system. If I'm somebody that is going to loan money to the government or loan money to a corporation, I want to know that they have some base reserve asset upon which everything else is built. If I'm going to give the government capital for bonds, I'll put a B for bonds there, I want to know that the government has gold at its central bank. Hey, I'm going to loan the government 100 currency units, and I want interest of a couple currency units a year because I believe in the future they're going to be able to raise more taxes because, you know, we have an advanced society here. We have plenty of resources. You know, I'm pretty confident for me as an investor that I'm going to get my interest back, right? I want my interest back every single year, right? But I don't want to just give them something I can print out of thin air. I want it to be backed. I want it to be built upon a foundation, something that is hard to print. And so, of course, you know, okay, great. This company has a good amount of reserves. This government has a good amount of reserves. You know, everything's good. I am willing to take the abstraction and go farther out on the curve away from utility value into monetary premium. Bonds have a greater monetary premium than gold, right? Because they're less abstract. Gold takes energy to produce out from the world, right? You have to turn dirt into gold after a lot of energy, after a lot of manual labor, at least back in the olden days, and a lot of refining, right? Maybe you can use wind power or you can use the combustion power of fire or whatever, right? But it takes energy to make gold. Bonds, a government official can just sign it into existence, right? And so the attachment, the tethering of the bond to gold, this is the bedrock for the future. And so what does that do? Well, hey, the government is happy with that because the government is getting more capital coming in. And what is the government going to do? The government is going to take that bond and they're going to go out there, just like the Dutch did, just like the Portuguese or the Greeks or not the Greeks, the Chinese or the British or, you know, the Germans, or, you know, you can go on and on and on. And now any modern country today, they can go out, they can raise that capital, and the government can take that and they can defend themselves with weapons of war to protect the society, to protect the jurisdiction, right? You know, they have the capital, they have the reserve assets, right? They have the land, they have the people working the land, they have the labor of the land, they have the gold, which is the fruit of excess productivity, right? Beyond all the essential productivity to help people eat hand to mouth, all the excess energy is going into gold, and that's our reserve asset here that, you know, we're going to build this future upon. Now we can build a military. Now we're going to have stocks involved as well. I'm going to do a little chart here to represent stocks. We're going to give money to the Dutch East India Company, and they're going to take that and they're going to go out there, and instead of war, they're going to go out there and trade with everybody, right? They're going to put a little dollar sign there, right? They can take that investment, go out there and make more money and build atop that, right? And then you can have other assets that are created, right? You can build more and more and more assets with different kinds of monetary premium that are greater and greater and greater abstractions of the commodities, of reality, right? You know, a stock, you're buying just a piece of paper. You can't eat a piece of paper. There's no intrinsic value to a piece of paper, but it's tied to reality still, maybe not with gold necessarily, but a different kind of commodity, right? The spices, right? We'll put S for spices, right? Maybe you're buying the stock of the Dutch East India Company, and maybe they don't have gold on their balance sheet, but you know that they're going to acquire something as a bedrock that is tied to reality. It takes energy to produce gold. It takes energy to produce spices. They're on this end of the spectrum. And so I am willing to part with my political currency units, my Dutch guilders, to give it to said VOC, Dutch East India Company, so they can go out there and acquire more spices. And so even though I've taken a bit of risk and bought an abstraction of energy, you know, a number representing a share of ownership of excess productivity, I'm fine with that because it's built on something that's real. It's built on something that's tangible. Maybe the stock itself isn't tangible. Maybe the bond itself isn't tangible, but it's all tied to reality. The government is probably not going to default on their bonds, because if they default on their bonds, it probably means that there's going to be all kinds of war and chaos because other countries own each other's bonds, and that is the bedrock for the entire system. So where do things go wrong? Where do things go wrong? Well, if I am a CEO of a company, if I'm the boss of a company, or if I'm the boss of a country, it's a lot easier just to make more bonds than it is to get more gold. Gold, like I've been saying over the last few minutes, gold takes energy to produce, right? That could be frustrating. And I would much rather just produce more bonds. I'd much rather just print more bonds. It's a lot easier just to do this and create more and more paper without needing the gold, right? And that's a massive incentive for me to do so because, hey, if I could raise more money by issuing more bonds, but without having the gold, well, then I could take that profit and I could expand my army and I could go out there and I could confiscate land, or I could take over foreign nations, or I could enforce stricter trade routes, or I could raise taxes a bit, right? I could do that and I can bring in more underlying assets, right? I can raise this capital from the population just by printing it out of thin air without needing the gold in the first place. And then I can go out there and expand and bring it back into the base layer here, right? Bring it back into commodities, into land, into labor for our country here, right? And so the problem is that that's not based on reality. We have now an abstraction that's an even greater abstraction than before. The bonds that were backed with gold, the political currency, the dollars, the guilders, that were backed with gold, that were backed with a hard commodity, those are already an abstraction, but now we have an even greater abstraction. And the problem is, when this all detaches from reality, and we begin to have a system where the risk-free rate of return is a debt-based instrument, that's where we have our critical problem here. When gold or land or whatever the real commodities are no longer the base layer, but now it's a debt instrument, right? If we have a debt instrument, if we have that as our bedrock for the financial system, we have a very real problem, because now all of a sudden we need to financialize the commodities, right? Let's say on top of debt we have, and let's clarify, let's be a little more specific. This kind of debt is, and now I'll bring it back as a metaphor to the present day, I guess. U.S. Treasuries are the bedrock for the modern world. And the same thing was true of many other former empires in the world, right? When you transition away from gold or land or fixed commodities being the bedrock where everything is pegged to, when instead you have debt, when you depeg the debt or the abstraction from reality, when you depeg it from reality, now we have a debt-based instrument that is our underlying asset. Now we have real estate, we have stocks, I'll put S&P for referring to the S&P 500, and also we'll put U.S. dollars, we'll put USD, and of course bonds are the bedrock of the world. Bonds are what run the world. And so here's the problem that we have here. If this is the foundation as a bedrock for the financial system, and every year it's got to pay out interest, well, the problem is, where does the interest come from? Right? If we don't have something that's underlying, where does the interest come from? Well, it has to come from something real. And for the government, what that means is it has to come from taxes. It has to come from, being able to afford itself, right? And this is the problem when you have a financial instrument being the base layer instead of a bearer asset. When you have the financial instrument being the base layer, something that's debt-based, the problem is that if that flow stops coming in, then the debt is worthless, because the whole concept, the whole abstraction of the debt is on the idea you can pay it back. Now, of course, if you have it backed one-to-one with something like gold, of course, if you have it backed with something, well, then when people redeem, then there's no problem. You can redeem it back and forth either way. But again, assuming we've advanced to a stage where society has developed so much over so long that people are forgetting the reality of, what needs to be the bedrock of the economy, well, now it's no longer based on being pegged one-to-one. It's based on that income. If the United States government, for example, were to suddenly stop having the ability to collect taxes, then the whole thing falls apart, right? If the U.S. government's military is no longer able to enforce the laws of the U.S. Constitution and of the dollar network, well, then the dollars are worthless, the bonds are worthless, and the whole thing falls apart. Because why would you own an American bond when they don't have the real world income to pay back your political currency units, right? And so how do they get that? How do they get that income coming in to pay the underlying debt? Well, you got to get it from something that's real. And since you don't have anything that's real that's backing it, the best thing you can do is to collect that thing that is real from the things that are abstractions of what is real. We have flipped the script. While before we had the bedrock being what was real, what was, essential, what took energy to produce, to abstraction on top of abstractions. Now we've inverted it, where the bedrock of the financial system is something that's totally deprived from reality, where it's just made up out of thin air. And the things that are more real are the dollars, the S&P 500, stock market, and real estate. Because real estate sure is built atop that, but at the same time, real estate takes energy to produce, right? People need housing to live, right? It is a commodity. And housing should be a utilitarian, consumer good, right? The stock market sure is just numbers on a screen and it's all kind of made up. But at the end of the day, the S&P, or the stock market, companies, corporations are producing cash flow. And that cash flow is something that's valuable, right? They're producing a profit. They're producing commodities, right? And those commodities people are willing to pay for, and they're willing to pay for that profit, which is coming from other kinds of commodities. And so these things are being taxed, right? We're taxing the real estate. We're taxing the S&P 500. And the reason why I include the dollar up here as well is because that's political power, right? The U.S. dollar network is a form of political power, political control. We print dollars, we export it to elsewhere in the world so that we can, at a slight discount, collect their resources, right? Dollars are our biggest export of the world. So we're collecting that political energy. We're collecting that corporate energy via the cash flows by taxing it. We're collecting that real estate property tax. We're collecting the income taxes, right? You have labor, you have all kinds of other things, right? We got to keep the money coming in to service the interest payments on the debt so that that's not wiped out. But here's the underlying problem here, is that it's not sustainable. This can't go on forever because the problem is housing, to use one example. People want to build more. People want more land. We have growing populations where we have more houses needing to be built. And we, as a function of society and technology progressing, as a function of success on this end of the spectrum, we have a greater abundance on this end of the spectrum. The more successful the Dutch East India Company is at producing more spices from around the world, the margins on commodities go down. Because guess what? We've gone from spices being that of only royalty to now anybody can have spices that are 6 months expired sitting in their pantry and you forgot it exists, right? We have allowed the marginal cost of production to trend to zero as a function of us progressing on this end of the spectrum, where we get more and more abstract, where we have a greater division of labor, where we have more productivity. As a function of that, this gets cheaper and cheaper. As we have more technology and more progress, it gets easier and easier to mine gold. It gets easier and easier to build more houses. It gets easier and easier to build more land, just like we talked about the Dutch before. It gets easier and easier to build everything, right? To where you can have a literal supercomputer in your pocket, right? Everything is getting cheaper and faster and better. And the faster we innovate, the faster that's the case. And so therefore, prices and the margins go down. And so that's a problem when you have a debt-based system, because the debt is a fixed price. But if the prices are going down, and the whole survival of the system is based on that consistent flow of currency units, now you got a very real problem. Now you have a conflict of interest. On this end of the spectrum, you need asset prices to go up. And on that end of the spectrum, the free market is forcing prices to go down, right? Let's use the metaphor of the Dutch East India Company, and then we'll come back to housing here in the United States. The Dutch East India Company, as an example, or Dutch bonds, right? You need to have spices. You need to have the commodity that is the product of your empire. You need to have those prices go up, because if the prices, if we're here in the 1700s, Dutch Empire, you need the prices of your diamonds to stay high. You need the prices of your spices to stay high. You need the prices of your housing to stay high. You need even tulip bulbs. Obviously that was a little bit more of a temporary bubble, but the point is, with all your commodities, you need asset prices to stay high, because if asset prices fall, then the margins get squeezed, your companies start to become less profitable, you're able to the government is able to squeeze less juice to fund the debt and the debt-based economy, and therefore everything starts to fall apart. And to get back to the metaphor of here today, with housing, I think it's one of the best examples people can understand. Oh, a lot of you watching this video, you are trying to get your first house, or you're trying to upgrade your house, or you have a growing family, right? Some of you watching, I know, have multi-million dollar houses. And even, and I know that for those that don't have multi-million dollar houses, it might be hard to hear, but even for people with multi-million dollar houses, I've seen this happen many times where they're in a beautiful place, they like their home, but they're trying to downsize or they're trying to move. But the reality is that their mortgage payment is so cheap, or the interest rate they got for their mortgage is so low, that they feel kind of stuck on that house. Now, of course, they're usually very grateful because they know that they're in a, more beneficial situation than most, let's say, but people feel stuck with where they are. And this is fundamentally why. We have two forces competing with each other. And the better we are at for allowing prices to fall to the marginal cost of production, the greater the need for us to continue forcing prices up. Housing should be getting cheaper and cheaper and cheaper as we have more technology that can build houses faster, cheaper, and better, that, for more people, right? We should, because housing is a utilitarian, commodity, we should be seeing house prices fall and fall and fall. It should, when you have houses, more abundant houses for the same amount of demand, if you build more houses, prices should come down. But the problem is we have constructed many, many, many layers up with a massive amount of leverage. We have constructed the entire financial system to depend on house prices going up, right? If house prices stop going up because you've put a bunch of debt on these houses, and because the spread between real estate mortgages, right? Okay, so let's add another layer here, right? Hopefully this is on my screen here, but let's add MBS and CDO, right? This is the great financial crisis in a very, very, very oversimplified terms, right? You have mortgage-backed securities and you have collateralized debt obligations, CDOs, that are an abstraction of an abstraction that are dependent on U.S. Treasuries, right? So U.S. Treasuries are the bedrock for the system. You have real estate prices, which go up as a function of U.S. Treasuries continuing to survive. And then you have derivatives, you have debt, you have securitized products dependent on the housing market. To, I guess, explain that with a little bit more detail, if U.S. Treasury rates are, let's say, paying, 2% in interest, theoretically, well, then real estate borrowers maybe are paying 3% on their debt, on their mortgage or whatever. And the people that are buying, they're buying that debt, they're buying the debt for the real estate, they're buying a derivative of a derivative of a derivative, and they're making some spread or whatever, so they're making the 1%, right? People, the problem here is that when you have a debt-based system, both the asset and the liability are debt-based. So the debt is obviously a debt, right? The mortgage is obviously a debt to the one taking out the mortgage, but it's also become the base asset for the person on the other side of the trade. And so the problem is that if the assets start blowing up, right? If you have mortgage-backed securities start blowing up, you have the CDOs start blowing up, right? If you have these securitized products start blowing up, well, then all of a sudden that causes the problem to the real estate, which then causes a problem to the U.S. Treasury, right? If we didn't bail out the banks in 2008, what would have happened would have been that housing prices would have continued to fall down and down and down because we have pushed so much premium into housing from financializing it. Instead of treating housing as a utilitarian good, we treated it as a financial store of value, right? Like basically as a forced savings account, right? It's one of the reasons why people buy houses, and it's why people take out mortgages, is because they treat real estate kind of like a savings account. And the reason why we do that is because the government, we just freely print more and more treasuries and more dollars. And so when the bedrock of the financial system is no longer the proper storehouse of wealth, well, then we have to treat something else as a proper storehouse of wealth. And so then we'll choose other derivatives that are not based on reality and pump those up because they're at least somewhat tied to reality, right? Bonds are, printed out of thin air, but at least real estate and at least stocks, are kind of tied to those cash flows, right? At least tied to that. So this is the underlying problem. And this is why Bitcoin is, Bitcoin and the inflation of the dollar is largely inevitable, is because we have these two systems. On this end of the spectrum, we have the free market that is trying to make things cheaper, faster, better for more and more people. And the faster we innovate, the faster we build AI, the faster we build new companies, the faster we build new innovation, the more and more those prices are going to come down. And the faster and faster they're going to come down. But on the other end of the spectrum, because we're on a debt-based system, because we're on a debt-based economy, because all the assets are debt-based, right? You know, people that have, let's say, a 60-40 portfolio, let's say they have 60% in bonds, let's say they have 40% in stocks because that's what they've been told. Problem is that all of that is debt-based, right? You think you have, let's say, $10 million of assets. You got $6 million in bonds, $4 million in stocks, and you think you have $10 million of assets. And that's true, but those assets are also a debt to somebody else. That's 60%. You have that $6 million in bonds. That's just debt owned by the government. And the government is in the business of printing more of that debt and creating more of that debt, right? So now all of a sudden you're owning something that is able to be mass produced again. And the 40% of equity in companies, the problem is that those companies are largely trading at a massive premium because they've been detached from reality of what they actually should be trading. The stocks are trading higher and higher and higher, despite them making things cheaper and cheaper and cheaper and faster and better. And so this is the problem. Who wins at the end of the day? Does the free market win? That's trying to make things more abundant for more people for a longer duration of time? Or does the financial sector win, where we have to have house prices go up forever? Otherwise, all the houses become underwater. If the houses become underwater, then all the derivatives with the houses become underwater. And if property values fall too much, we can't get enough of those property taxes in. If we can't get enough property taxes in, well, then the amount of revenue that's coming in versus the amount of expenditure required for these bonds completely goes invert, and then the whole bond market fails. If the bond market fails, you can't subsidize, you can't fund the military. If you can't fund the military, well, now you have a global war in your hands. This is why the government will do whatever possible to keep asset prices high, because if asset prices fall, the whole thing unravels. If people's incomes, if people's wages start to fall, then the problem is the government can't collect as many income taxes. If it can't collect as many income taxes, then the debt to asset ratio completely blows out, right? If they have a whole bunch of debt, you know, or let's use small numbers here for the sake of example, right? If they have the bedrock of the financial system being, you know, again, U.S. Treasuries, they have the whole bedrock of the financial system being U.S. Treasuries, and they have energy flowing into the system. Let's say they collect $100. Hopefully that's showing up well enough. Let's say they collect $100 of revenue, and they have $100 of expenses. If that's the case, but then all of a sudden they lose 10% of their income, they lose 10% of their taxes because property values went down and therefore people can't afford the property taxes anymore, or incomes went down and therefore people can't afford the income taxes anymore, or capital gains tax with stocks, or this or that, or, you know, pick your tax, whatever it is. If that starts to go down, now they have only $90 coming in, well, this all of a sudden the whole thing might become worthless. If they can't pay that interest out, then the whole thing is marked to zero. Then it's all gone. They have to keep taxes high enough. They have to keep the incomes high enough to keep the bond market from going. Because if the bond market were to fail, well, then all of a sudden, how is anybody going to get a mortgage on their house? And if you have house prices being dependent on people's ability to get mortgages, but nobody can get a mortgage because no banker is willing to borrow from the U.S. government to take that spread, then how are they going to do that, right? You know, just to summarize maybe real quick, let's say over here we have the Federal Reserve. Let's say we have Fed. Just to summarize with how this works, over here we have the Treasury, which we're going to put a T, and then we have BB for big banks. Big banks. The way that in America, the way that our system works is basically you have the big banks, which are private entities, quote unquote. You have the Federal Reserve, which is, you know, independent from the government, right? Which that's a rabbit hole which we won't go into. And then you have the Treasury. The Treasury prints the bonds. The Fed creates the capital, and then they work with the banks to buy the bonds. Basically, banks say, hey, we want to write $100 billion of mortgages to homeowners so that we can collect that income from homeowners, right? We want to collect that income from homeowners in the form of monthly payments, right? We want that income stream. Why? Because the dollar is depreciating every single year. We got to have that spread to keep our business afloat. So what the Federal Reserve does is the Fed says, hey, America needs more debt. America needs to sell more bonds. We're the business of selling more bonds. But we need to make sure that the Treasury has consistent demand for those bonds. So what we'll do, Mr. Banker, is we will give you money. We will give you money we'll create it out of our balance sheet. We have an infinite amount of cash at the Federal Reserve, right? As they have said before, we have all this cash. We're not printing money. We're not printing money at all. We are printing money that we can just inject into the financial system via debt. We give you the money on the agreement that you take the money and you buy bonds. You buy bonds from the U.S. Treasury, right? America needs to keep raising more debt. We have to keep raising more debt to keep funding the army, to keep funding the government, right? Because we don't have the asset peg, right? That's the base asset, but nobody's willing to buy that, right? So we have to have the Treasury make the bonds. The banks take the money from the Fed. They buy those bonds, and then they collect the spread between the bonds and between the higher interest debt that is higher on the capital stack, right? The mortgages are considered higher risk than the bonds. So the bonds, let's say they're paying 2% to the government every single year. They're collecting 4% of interest from the mortgages, and the big banks are happy because they're in the market of making free money. They don't care that the interest rate is below the asset inflation rate. They don't care that the interest rate is below that even of what they think inflation might be. They don't care because they're making free money. They're getting free money from place A, giving it to place B, getting debt back, and sure they're paying an expense every single year, but they're collecting the interest from everybody else. Something I talk about a lot, transitioning to Bitcoin a little bit, with Bitcoin is about how you're going to be able to get all kinds of capital for the sake of acquiring and buying more Bitcoin. This is something I'm helping clients with in mine. This is something I think is going to become even more prevalent in the next few decades. Like, the governments need to print trillions and trillions of dollars to continue the whole flywheel going, to keep asset prices floating up. But the problem is, if you keep housing going up forever, if you keep stock valuations going up forever, eventually it's so detached from reality, nobody can afford a house anymore. Nobody can afford, nobody can justify paying half a millennia of future cash flows on a company that, like, eventually gets so detached from reality, they can't force it up anymore, which is when these two forces come to a head. So my point is that people ask me all the time when it comes to the Bitcoin loans, Luke, why would anybody ever lend me money at 5%, 7%, 4%, 2%, 9%? In my opinion, I think it's not too far in the future that people will be able to borrow to buy Bitcoin, new capital to buy Bitcoin at 0%, 1%, 3%, right? I think that's coming. And a lot of people in Bitcoin ask, why would somebody ever lend me capital to do that? It's because they're borrowing from the government at an even cheaper rate. And so, anyway, I digress. Getting back to the big picture here, that's the concept. That's the business model. If you're a big bank, borrow the political currency that's just printed out of thin air, that takes no energy to produce like actual commodities, borrow the political currency made out of thin air, and then use that to reinvest it back into assets that are somewhat tied to reality, like real estate or like stocks or whatever, and then you can collect the higher interest rate for that. But again, this is the problem, and this is what causes that big cycle we were looking at earlier to then begin to unwind, is this is where these two forces really meet ahead. If you have, like in the Dutch example, if you have as a curse, as a winner's curse of your own success, if the margins on the commodities that has built your empire and has built all the credit instruments and derivatives for your empire, if all those commodities have decreased in price, if they've decreased in their margins, well, now all of a sudden you can't justify these high premiums anymore. You can't justify, if spices, if you're selling spices at $10 a unit and you're collecting all those margins, and your stock and your markets are all pricing the future with more and more premium as you're going up and up into the curve, right? Instead, like we were talking about before, right? Instead of, commodities having the premium, now we have financial instruments getting the premium, right? They're getting more and more premium because these things are falling down and down in relative value, which is a good thing. We want housing to be more affordable for more people. We want people to have food. We want people to have water, right? This is a good thing. We want a higher and higher premium to the storehouses of wealth as we're extending the time horizon. We're extending the frequency of people's vision into the future. Less people are starving. More people are planning for their grandchildren, right? This is what we want. This is good. But the trade-off here, the problem is, because the honeypot problem is so massive of an incentive for people to just print more and detach from reality, and people assume that things will always be this good, and yeah, sure, we can detach from reality, it's no big problem. The problem is these premiums get so large that when these prices fall ever close to the marginal cost of production, then the premiums collapse, right? If you're selling, if you are a spice company in the Dutch era, right, and spices used to be $10 a unit, but then they went to $3 a unit, and now we were so dang successful, it's literally 100 times cheaper, and now it's 10 cents. Well, all of a sudden, if you're pricing your future equity at this massive premium that it doesn't exist anymore, what do you do? What do you do? And this is the problem. This is why empires begin to fade, they begin to collapse. Is when, like the Dutch, for example, they had to keep forcing the price of housing up. They had to keep forcing the prices of everything up. And what happens when that happens? If people can no longer afford things, they can no longer afford housing, they can no longer afford these things that are artificially expensive, they go to other economies, they go to other nations that are earlier in their cycle. Why would I mean, sure, it was nice, and here in Amsterdam, it was the most prosperous place in all of Europe, a generation ago. But now here I am, and all these other countries out there, all these other nations have adopted our technologies. They have adopted our shipmaking industry, they've adopted our lumber technologies. They have their own spice trades of their own. Why would I stay here where things are artificially expensive? I'm just going to go elsewhere. I'm just going to go to this other place where things are actually better off for me and my family. I'm going to go there. And so then you have this shrinking of premium, you have this draining of capital, you have this slowing rate of technological adoption and acceleration, as we have less and less of a productive economy and more of a regulatory economy, and this causes everything to shrink. This causes even more greater downward pressure, because the only businesses and industries that are able to survive are those that are able to do things in mass, right? Do things at scale. Right here in the modern world, this is why so many of the large companies, the S&P 500, 39% of the S&P 500 is in the top 9 companies. 7% is in NVIDIA alone, and NVIDIA alone is worth 2x the GDP of Canada. NVIDIA alone is worth more than the entire stock market of France at the time of recording, right? The reason why these tech monopolies are gaining so much premium here in America is because they're the only businesses that are able to compete with this, right? They can continue to centralize, and the more they can continue to centralize, the more of an unfair advantage they can get from the government, because the government needs to subsidize these industries so they can keep having the premium go up and up and up. And this is where you have an immovable object meeting an unstoppable force. And that's the underlying problem. When you have the free market trying to force prices down, but you have a debt-based system denominated in the currency that needs to have asset prices inflate forever to continue eroding the debt, that's where you have conflict. And one of these two has to win out. If this side of the spectrum wins out, then you have a financial collapse. And if it's the inverse, and you don't have that, and instead you have a shortage, commodities, you have them spike up. I don't know if that's entirely visible. Dang it, that's not entirely visible. If you have asset prices going down, then they go up. And this is how it happens. You have so much productivity, you have so much complacency, that eventually the premium of the entire system falls away, because everybody realizes we can't justify it anymore. And debt, when it cannot be paid, gets marked to zero, right? Gets marked down and down and down, and you have the commodities go back up, because we've been spreading and spreading and spreading and pushing things unnaturally for a very long period of time. So let's talk about what this actually means. What this means, when we're talking about reality, and this is my prediction of where we're going in the future, what this means is that there's a few things you have to know. Bond prices, bond yields, stocks, let's see, stocks, I want to say stonks, and then Bitcoin. We're going to add Bitcoin. We're going to introduce that again. So if you're looking at history, how this has played out in history, and then projecting forward, guessing here in America how this is probably going to look. America needs bond prices to keep going up because we're so highly over-leveraged. If you're making 2% on a bond, but the bond falls 20% in value, then the value of that bond is just erased the next 10 years. So of interest you're going to get, right? And so the big banks, which are the biggest buyers of bonds, they need bond prices to go up. And so what you saw this in the Dutch, you see this in the British, you see this in many other empires when they are being over financialized, and you see this many times in history. But what you see is you see bond prices go up and up and up, right? That's what the government wants to see. The government wants to have demand for their bonds, because the more demand that they have when they go to a treasury auction, the more demand they have, then that's more money in the government's pocket that they get today without having to directly print money or whatever, right? They have bond prices go up. Now, the best way to make bond prices go up consistently over time is to suppress yields on your bonds. And this is something that is very counterintuitive for people. And this is one of the best pieces of advice I can give you. This is financial advice. My encouragement would be, no matter where you are on the Bitcoin spectrum, maybe you're just a brand new Bitcoin beginner, or maybe you're somebody like myself that is hardcore Bitcoin evangelist, wherever you are in that spectrum, it is financial advice of mine to encourage you to learn about how the bond market works and learn about why bonds and yields are inversely correlated, right? Meaning that the lower your yields go in general, the higher the bond goes, right? Now, why is this the case? Well, if I buy a bond today and that bond is paying me 3% interest, let's use dollars here, right? Let's say I buy a bond for $100, and let's say that bond is paying me 3% interest every year, right? It's paying me $3 a year. That's great. That's awesome. Okay. Now let's say a year goes by and the government can push yields down a little bit. Well, they push yields down. They push yields down a little bit. So now the new bonds being issued are 2%. Well, all of a sudden, my bond is worth a heck of a lot more, because the current market rate set by the government, so quote unquote, it's not a free market, right? The current market rate being set by the government is 2%. Well, hey, guess what? If I have this bond that I own was paying 3% a year, the free market now out there is going to be willing to pay more for my bond. Why would I spend $100 to make $2 a year buying a bond that's issued today, when instead I could have bought Luke's, when I could buy Luke's bond off the market paying me 3% a year, right? This bond is now worth more. Instead of being worth $100, this bond is worth $150, because I'm getting 50% more money for the interest rate, right? Again, there's a lot more nuance. I know I'm really skimming over this, but that's the general concept, right? So my point is, and this is where things go wrong. This is what the Dutch did. This is what America's been doing for the last 50 years. This is what the Chinese have been doing, the Japanese, the Germans, the French, the British, basically every country in the world. This is the problem. We have not ever had a historical precedent for this, where basically every country in the world, independently and collectively, every major central bank in the world, the Fed, the BOJ, the PBOC, and the ECB, all the central banks of the world are doing this in tandem together. This is a massive, massive, massive problem. This is not a free market. We do not live in a free market, right? We have the free market trying to produce more housing, trying to make more food, trying to make more wealth for more people. But government interest rates and government debt, which is the base layer asset for the entire world, that is not a free market. They're manipulating things to artificially force bond prices up. Everything in the world is a free market other than the currency which we're pricing everything through, right? It's like if you're trying to sail the open seas, but your telescope is being manipulated by somebody, well, then how on earth are you going to be able to navigate where you're going in the world, right? This is why there's so much noise and so much chaos in the world. Nothing makes any sense anymore. It's because you're looking at everything through something that's being artificially manipulated. And so in America, we've been forcing bond yields down artificially for decade after decade after decade. The same thing was true, with the Bank of Amsterdam, right? And we're artificially forcing bond prices up and up and up. We're becoming more and more financialized. We're making the stakes even higher and higher and higher. We've gone from the threat of a treasury auction failing being bad to worse to horrible to now apocalyptic for the financial system. And what does this do to other assets, right? Well, I'm going to add real estate as well, because that's another important one. I know that for a lot of people it's important. Well, when you have yields going down and down and down, what happens? Well, real estate prices go up and up and up. Why is that the case? Well, if you can't store your wealth in political currency, because we're printing US dollars, we're making dollars less and less valuable over time, because we have to print more dollars to pay the interest aka yields. We have to print more dollars because we're borrowing more debt. We have to print more dollars to pay the yields so we don't default on bonds. We only have two options. Either America can default on the value of dollars, or they can default on the debt, right? If you can't pay the interest on the debt gets wiped out and the whole thing collapses. So the only other option is to dilute the denominator upon which you're paying the yields to the bondholders. So one of these two has to go down. And America consistently chooses the dollar because they would rather steal from the working class instead of defaulting on the bonds and have World War III within the next 6 months, right? It's like, that's the obvious incentive, right? And this is a part of the problem, right? This is not something that your favorite politician can fix. This is not something I can fix. If you put me into office, if you put you into office, you would not choose the alternate. I would choose to print more dollars, right? And this is the problem when you have the entire system based upon something that is debt-based. It doesn't matter how moral you are. It doesn't matter how ethical you are. It doesn't matter how smart you are. You have to follow the incentives. You have to follow the game theory. You can steal from people next year, or you can blow up the world next month. What would you rather choose? Everybody always chooses the dollar, debase the dollar, default on the dollar so we don't default on the bond. So anyway, all I'll just say is that the everyday person is now at this tough point where it's like, hey, the economy's good. We're producing more wealth. I shouldn't store my wealth in iPhones because we're going to make more iPhones. I shouldn't store my wealth in corn because we're going to grow more corn. I shouldn't store my wealth in oxygen because nobody pays for oxygen. I need to have something to preserve my purchasing power into the future as I'm extending my time horizon and lowering my time preference. But the dollar is not a good storehouse of wealth. And so what do? Well, I could buy bonds, but the yield on these bonds are now relatively low. And the lower and lower we make those yields, the harder and harder it is for me to get a payout, right? In the 80s, maybe I was getting a 10% interest rate on that bonds. Hey, that's pretty good. I make my money back in 10 years or whatever, right? But now if the interest rate is 3%, that's 33 years. That's a long time for me to make my money back. And if I'm making that money back denominated in US dollars, I'm basically guaranteeing a loss. And now if I'm buying bonds at a 1% yield, but if inflation on paper is 3%, in reality, it's more like 6%, well, then the problem is that basically the only reason I'm buying a bond is because I know this is the last thing that is going to default because it's secured by the full faith and trust of the U.S. government. Everything else is going to default besides the bonds if I'm in the mentality of bonds being the bedrock of the financial system. That is the mentality I have, right? And so really, you don't buy bonds anymore for the upside or for the income. You buy them to reduce the perceived volatility in your portfolio, but you also need something other than bonds. And that's where the stonks and the real estate come in handy. It's because if we know the dollars are going down, and if we know yields are going down, and bond prices are going up, well, then real estate is going to keep going up because people can keep refinancing. They can refinance their mortgage again and again and again because bankers are able, that spread gets lower and lower, right? If the yield is 10%, then they can sell a mortgage at 12%, and the bankers are happy. And then you move forward 50 years, and then if the bond yield is 1%, theoretically, then they can have real estate mortgages be 2 or 3 or 4%, and they still make money. And so therefore, the more people are able to borrow to buy more houses, the more that the price of real estate is going to go up. And the same thing is true with stocks, right? The same kind of concept, right? The stocks produce cash flow, and we give a future premium to that cash flows, right? We're willing to pay a bit extra above what those cash flows are worth for the future. And if the companies on the stock market can work and borrow at cheap interest rates, they get cheaper and cheaper and cheaper interest rates over time, well, then this is all very good, and I'm willing to justify a higher and higher and higher premium to those stocks. And so what happens with the stonks? Stonks go up and up and up and up and to the right. In the case of in case here in America, they go up really, really firm, right? And then we have Bitcoin, this other kind of separate world asset. And here's the difference, right? Bitcoin, I'm also going to put gold here because we've been talking about the Dutch, and 400 years ago, the asset outside of the system was gold, and in these days, it's Bitcoin, right? Bitcoin takes electricity to produce. Gold took the movement of dirt to produce, right? You had to move dirt to acquire the gold. With Bitcoin, you have to have computers move electrons to acquire the Bitcoin, right? It's the same kind of concept. Both of these are very interlinked assets in that they are bare assets, bare instruments that are not debt-based. All of these assets are debt-based. And this is the critical problem that most people have when they don't understand why Bitcoin is lower risk relative to everything else. Most retirees have 60% portfolio in bonds. Maybe they have, well, actually, we have to include the real estate as well. Let's say real estate is a third. Let's say real estate's half. Let's say real estate is half of the person's wealth. And then the other half, they have it a diversified, quote unquote, 60-40 portfolio. Because they're older, because they're retired, whatever, they have 60% of that portfolio in bonds, 50% of 60% is 30%. They have 30% of their net worth in bonds, they have 50% of their net worth in real estate, and they have 20% of their net worth in stocks. And this is the problem. Okay, this is really important. And when talking about the Dutch 400 years ago, 300 years ago, when talking about the Chinese, when talking about the British, and now talking here about America, this has been the world so far. We've had a world that's gotten more and more financialized, right? These are the financial assets, the debt-based assets, and these are the bear assets. These are the commodities, right? And so what we have here is a very real problem where people are looking at the world through their lens only with what they've seen. Most people alive today, unless you're in a foreign nation or in a nation that's had a hyperinflation or a war or a default, most people alive in the Western world today, this is all they know. This period of history, the last 80 years or so, all they know is that bond prices go up. All they know is that yields trend down over time. All they know is that real estate trends up over time. All they know is that stocks trend up over time. And this makes logical sense. It is consistent, and plenty of smart people, plenty of billionaires, far more successful than me, plenty of these people that have plenty of money, this is their worldview. And this is the lens they're looking at the world through. Because they're looking at the worldview that the risk-free rate of return is the U.S. bond and that a U.S. Treasury auction never fails. And so on the assumption that my debt-based system, never fails and the debt never defaults and never gets marked down to zero, on that assumption, everything continues to work. And some people, most people that believe that, say this will continue on forever. But I'm telling you, this will not continue on forever. If it can end, it will end, and this eventually will end. Every other time, historically speaking, this has ended. Granted, it is a very, very, very long time before it does. And in my opinion, we are far closer to the end than the beginning. This has been going on for the majority of a century now here in America. And, I don't know how much longer it will last. For the case of the Dutch, it lasted, 200, 300 years, roughly, so to speak. But history happens a lot faster now than it did then. The periods of iteration get faster and faster. But the point is, the problem is that you can have yields go down only so much. You can have real estate prices go up only so far before people can not afford houses anymore. And you have stocks only go up so much. And the government will do whatever possible to save the bond market. They will turn 30-year mortgages into 50-year mortgages, 70-year mortgages, 100-year mortgages before the default in the bonds. They will let the stonks go from 30 years of premium to 50 years of premium to 500 years of premium before they let the bond market fail. This is what runs the world. This has been true with Trump. This has been true with Obama. This has been true with every president. If you want to look at some of the, if you want to look at the decisions they made, or not just here in American history, if you want to look at all these countries, if you want to understand why they made the decisions they did, they always made the decision that saved this because they understand, sure, if real estate has a problem, that's a problem. But the only problem for the government, if real estate goes down in price, is that it eventually threatens the bond market. Sure, the government cares if stock prices go down, but they don't want stock prices to go down too far, because if stock prices go down too far, then you can't collect the capital gains anymore from stocks, and therefore you have an income problem when paying out your bonds, right? Because they want as little money printing as possible to pay the yields to keep the bonds afloat. They would rather just collect the wealth from the asset holders, right? They would rather collect the wealth from people's incomes, right? They would rather take that wealth and redistribute that wealth back to themselves to pay the interest on the bonds, which are the base of their entire system. They would rather do that they would rather print as few dollars as possible, the minimum number of dollars possible to remain in power. But at the end of the day, they understand that if a treasury auction fails, then all of a sudden, everything is out the window. And so, all of a sudden, everyone's assumptions, and this is what happened with the Dutch, this is what will happen with us too, eventually. I don't know if it's going to be next year or 20 years from now, probably closer to 20 years. But at some point, what's going to happen is people are going to stop giving that premium to the bond market. And so what you're going to see, if you want to think of this like as a metaphor with the house fire, right? If bonds are the house and bearer asset commodities are the insurance on that, because it's outside of the system, because it's not debt-based, all these assets are debt-based, and they're all debt-based on the bonds. These assets are side of that. what you're going to see over the coming years is Bitcoin is going to trend up and up and up and up. Gold is going to trend up and up and up. What you'll see is that at some point, what's going to happen is that when all that's happening now is that, if you think of this like the insurance premium, it's getting a little bit more and more and more expensive over time as the free market is starting to price in a higher probability that the house burns down. But once the house actually burns down, what you see is a vertical up move in gold, an even more dramatic vertical up move in Bitcoin. And what you see is that people are no longer willing to pay these low, artificially subsidized yields on bonds. And this is the canary in the coal mine. When you start to see yields skyrocket in bonds, it is the free market telling you, we don't care that you're subsidizing this. We don't care that you're guaranteeing it with the full faith and credit of the U.S. government. We don't care. We want a higher yield. I'm not happy paying 1% anymore. I want 5% again. I want 15%. I want 25%. I want a higher and higher yield. And this is the catastrophe that the government is trying to avoid at all possible costs. If the yields start going up, well, then all of a sudden my bonds aren't worth as much anymore, because like the inverse of the previous example, if I was buying a bond worth $100 and I bought it at a 1% yield, where I was making $1 a year or whatever, right? Well, now the problem is that, wait a second, if that same bond is being issued today, now what's a 5% yield? Well, darn it, now instead of a $100 value for my bond, now it is collapsed to the inverse, where because it's 5 times more, it's probably only worth $20 now, right? Like, I just lost 80% of my bond. That was the next 80 years of income. I'm going to dump this. I got to, Mr. Government, I want a higher yield now, right? So what you see is that the bonds fall, and they fall, and this is something that a lot of people don't think can happen because they've not seen it in their lifetime. But if you look at history, you see that it happens every single time. The only question is the timeline. But when it does start, when, if you think of it like a forest fire, right? And that we're adding more and more brush to the forest for decades, and the failing of a treasury auction is a lightning strike, right? And so I don't know when the lightning strike is going to happen, but if we're adding more and more brush and we're forcing rates lower and lower and lower, well, then the reversal just gets even more dramatic. The longer this continues on, the even worse the fire is going to get, the even faster it's going to be in the unwind. And so just because it hasn't happened, and just because it may not happen for years and maybe even decades longer, just because it hasn't happened doesn't mean it won't happen. And the longer it doesn't happen, probably the worse it's going to be when it actually does happen. So what happens is that the yields skyrocket, the bonds fall, and people, or the government, has to print more dollars. And when you print more dollars, the value of the currency falls. And the reason why you print more dollars is because you have more yields to pay, and you're collecting less taxes. So you have to print more currency to keep paying the yields to slow the rate of collapse for the bonds. And so when you go to real estate, well, what happens? Well, it's like, hey, darn it, I bought $1 million house paying 2% on my mortgage, or paying 5% on my mortgage, or 8% on my mortgage, or whatever. I bought that house, but now nobody can buy my house anymore at the price that I bought it, because now they're paying, if the government's paying 5%, well, let's take a more dramatic example. Let's say they're paying 10% now. Well, now my mortgage should be 15%. Nobody can afford that. Nobody can afford that, right? And it's not that, and this is what people get wrong, is that it has nothing to do with the value of the land. It has everything to do with the financeability of the land. It doesn't matter if your land is still producing income. It doesn't matter if your land is still raw physical land. At the end of the day, the problem is nobody can finance it because the debt is too expensive in your jurisdiction. So what happens to the real estate? Well, the real estate falls, and probably doesn't fall quite as quickly or quite as dramatically, but it does fall a great deal, far worse than the Great Financial Crisis, because that was just with a derivative of a derivative. We're talking about the whole unwinding of the whole thing. And then stocks is the same thing. And so my point in saying all this is a healthy dose of fear. I'll give a little bit of hope in a minute, but it's a healthy dose of fear. My point is that the worldview people have, the lens that people are looking things through, is they're looking through the lens only of a financier. Everyone right now in the world is only looking at the debt-based assets, political currency, government debt, the yields that debt is paying, financialized real estate, and the stock market. All these things are debt-based upon the assumption that the treasury market survives. My point is, for right now, your worldview is correct, that this is how the world works. But the problem is, if you look at history, there are clear cycles where we cycle back and forth, where commodities are rare and therefore they have the big premium given to them, and where commodities are abundant and therefore debt-based assets that are representing ownership of the collection of said commodities en masse, right? Whether it's government or corporation, that's what's given the premium. And the problem is, right now, most people are looking at a world where dollars trend down consistently, bonds trend up consistently, yields trend down consistently, stocks trend up, and real estate trend up consistently. But nobody's prepared for the change in assumption where all of a sudden people shift their frame of view and they ask the question, what happens if debt is no longer what's given the highest premium in the world? What if the actual bedrock of the world is no longer a yield producing debt instrument? What if a bare asset, something could be backed 1-to-1 without debt, without any counterparty risk, default risk, rehypothecation risk? What if that becomes a standard again? And if that's what happens, well, then this is exactly what plays out. And I think this is going to take a very, very long time. I genuinely think Bitcoin is going to be millions, if not tens of millions, potentially even $100 million a coin before this happens. Bitcoin could easily be $10 million a coin and only a few percent of the global amount of wealth, right? Like, I hope and pray that by the time this starts to happen, Bitcoin is already a tremendous amount of the world's purchasing power. But my point is that the canary in the coal mine, the lightning strike, so to speak, in the forest fire metaphor, is the failing of the U.S. Treasury auction, or a consistent failing of getting bids in the U.S. Treasury auctions, and a really, really firm spike in yields. Because when that happens, you know, the dollar falters, the real estate falters, the stock falters, right? And this is going to take years. It's not going to be overnight. You know, like once that lightning strike happens, it might take 10 years for the whole forest to burn down, right? Once the bonds stop selling and everything, you know, starts unraveling, it might take 10 years for this all to unwind, but it's going to be a pretty brutal 10 years. And this is something that people don't understand when it comes down to losses. Your losses can be infinite. You can have something just start going down for year after year after year. And the problem is people think they're diversified because they're diversified between dollars, real estate, stocks, and bonds. But at the end of the day, you're not diversified. You're just diversified to different geographic locations of the same forest. It's all got the underbrush. It's all got the leverage in it. And your base assumption for why you're safe in diversifying there is because you have the assumption that the brush or that lightning strikes don't happen. But just because you haven't seen a lightning strike the last 6 months doesn't mean that it doesn't happen. Like, all it takes is one lightning strike, and that's where everything starts to unravel. So I've talked a little bit about the end game, but what's the important concept here? The important concept here that you need to understand is Bitcoin, BTC. Okay, what was the best thing to own when the Dutch began to fall apart? It was gold. You wanted to own gold. You wanted to own the bare asset. You wanted to flee that jurisdiction. The same concept is true with Bitcoin. What you're going to see over the coming years, and it's going to accelerate in the coming years and eventually in the coming decades, what you're going to see is that in Bitcoin world, in the free market, you're going to see prices fall and fall and fall, down and down and down to the marginal cost of production. Things in terms of Bitcoin will get cheaper and cheaper and cheaper. But in the dollar system and all the political currency systems of the world, you'll see things get more and more and more expensive over time, where it's just going to the inverse. And the problem is that this system has a bedrock of U.S. treasuries, which can be marked to zero because it's a debt instrument reliant on incomes being able to pay the expenses. But with Bitcoin, it is backed on energy. It's backed on electricity, right? So it's much more volatile. There's way more lightning strikes. But at the end of the day, there's not nearly as much brush. Bitcoin is not a leveraged asset. All these kinds of things are. And this is the problem, right? Mortgage-backed securities and CDOs were relatively stable before the great financial crisis, but they were dependent on the incomes being able to pay the expenses. And as soon as those incomes have enough defaults, as soon as a lot of those MBS and CDOs stopped having the income, they were marked to zero. And so the end is very, very quick when it does begin. And I think that's a very long time. But at the end of the day, the reason why Bitcoin works and the reason why Bitcoin is going to be a better bedrock for the future is because it is something that cannot be artificially manipulated. With the political currency system, you can artificially lower yields on and on and on indefinitely. You can artificially depeg the financial sector from the real world energy commodities that should back those securities. You can depeg that. You can artificially force yields down. You can artificially stimulate demand. And that might work for a while, might make you have a bit more power during your term serving in power. But when you compound those things on top of each other, and then you financialize the stock market, when you financialize the corporate sector, the ones producing wealth, when you financialize people's incomes and people's labors, people's labor, and when you financialize the housing that people live in, all of a sudden you have a place that's more and more focused on regulation and less productivity, and you just cause everything to cycle back in on itself. And so the reason why Bitcoin works when compared to everything else is because of what's called the difficulty adjustment. No matter how much energy is being thrown into Bitcoin, it automatically, algorithmically adjusts upwards so that the amount of future Bitcoins entering the network extends into the future. You can try to artificially inflate the number of Bitcoins produced in the next given iteration of time, but if you plow more energy into Bitcoin, trying to do that, trying to attack it, the difficulty adjustment every 2 weeks just extends that out into the future. So you can throw more and more and more and more energy into Bitcoin, and it will just make it more and more and more and more expensive for you to continue that attack and to try to inflate or try to issue more Bitcoins than what are currently in the moment, right? And so that's why Bitcoin, despite it being more volatile in price, is going to be a superior system, because the world that we've known so far with bonds, with stonks, gotta have a little bit of humor, right? With USD and what else? Bitcoin. Oh, and real estate. I forgot real estate. I'll put real estate right here, right? What we've known for a very long period of time is real estate just trends up and up and up, bonds trend up and up and up, stocks trends up, dollar trends down, and Bitcoin super volatile. And people think, here's the line of risk. This is all safe, that's high risk, because that's volatile, and this is all steady. But nobody looks at the risk of what is the bedrock. This is all debt-based. This all has the bedrock of being debt-based, and this has the bedrock of energy. Now, just because I think these things are going to fall in purchasing power doesn't necessarily mean I think these things will fall in terms of US dollars, right? You know, like stocks, for example, go up and up and up, and they might crash. They might crash in nominal terms, but because the dollar, in the same period of time with how the whole trade unwinds, also crash, it's totally possible stocks and purchasing power could fall 95%. They're roughly, they have to fall about 95% in terms of gold to reach a historical average. But they could still crash 95% and still just keep going up because the decline of the dollar is so much faster, right? So at the end of the day, in terms of purchasing power, putting the nominal discussion aside, in terms of purchasing power, I don't know how else to put it. Like, people think I'm being too much of a fearmonger. Maybe I am, I don't know, but it's just how it's going to go, because this is all one trade, and this is what you need to understand, that Bitcoin much more volatile and it goes up more, right? But the big point here, why Bitcoin is going to $100 million is because it is a short on everything, right? Forget the asset class itself, just thinking in terms of debt-based, energy-based, right? Like, none of this has intrinsic value. You can't eat any of this. You can't drink any of it. Sure, you can't eat or drink or sleep in a Bitcoin, but you can't do it with stocks, you can't do it with bonds, you can't do it with dollars. And real estate, we're talking about real estate from a financialized sector, right? If real estate actually was priced as a consumer good and not something as a forced savings account, the price of real estate would be falling. It's not falling, it's going up, right? So it's a financialized asset at this point, right? The vast majority of the value of any given house is in the financialized aspect of it. So if you strip the noise of all the talking heads and all the media people trying to guess what sector or what asset or what portfolio diversification is best, if you just strip it away and you view the world very simply, there are debt-based financial systems, there are energy-based financial systems, and into the future, looking into the future, if the world's going to be more productive, if AI, if robotics, if technology is going to make things more and more competitive for more and more people, you don't want to own debt-based assets, because that productivity, that technology, for an optimist on the productivity of the human race, that is a disaster for everything debt-based. And so right now, people think, oh, stocks only go up over time, bonds go up over time, albeit at a slower rate, real estate also goes up over time, And yeah, USD goes down, but it's consistent. It's stable. That's the whole point of a currency, right? The whole point of a currency is that it declines at 2% a year, right? Then you have Bitcoin. And so most people right now, they think they don't have this line. They aren't looking at the bottom. They're only looking at the top, and they're only looking at the price performance. And they say, well, if I have a diversified portfolio, this percentage of this asset and that percentage of that asset and that one, I can create a portfolio that trends up in dollars over time that's relatively stable. But they're not looking at it from the first principle and saying, you know what? These are not 4 different assets. These are all just the same trade, right? If I'm 60% bonds, 40% stocks, or vice versa, or I have real estate too, or whatever, all of this is just the same trade. All of this is a bet that we continue interest payments on U.S. Treasuries. And so all people have known, and I sound like the crazy person because people are like, oh, look, what are you talking about, right? Bonds and stocks are inversely correlated, right? When stocks go down, bonds go up, this, that, there. But they haven't lived through, and I haven't either, for that matter, right? Like, I'll be very clear with this. I've not lived through this personally myself. I could totally be wrong. I could be smoking crack. I don't know. I'm smoking Bitcoin at the very least, right? But when I look at history, and I think through the game theory of this, it seems to me we're going to produce more commodities in the future. And the more commodities we produce, the more these multiples compress, the more these tax revenues get compressed, the more desperate the government is going to become, the more tyrannical the government is going to become to increase the tax rates and demand more and more taxes because they aren't getting the same juice out of the lemon they were previously squeezing. And when that happens, people flee, you get a flight of capital, the feedback loop continues down and down and down, and when those yields start to spike up and the bonds start to unwind, that's the lightning strike, that's the canary in the coal mine, and the premiums and the stocks fall, the dollars fall, and all of a sudden, everybody over the last 50 years or their whole lifetime has been used to the same trade working out, where bonds and stocks go up, diversified portfolio, blah, 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 and all of a sudden, it all inverts, and it becomes the same trade on the downside. And nobody's ready for that because nobody's lived through it. I know I repeat myself, but it's very frustrating. And at the end of the day, what that means is that energy-based assets that can't default, those are the ones that survive. And those are the ones that do well. And thankfully, because of Bitcoin, because it's auditable, it's going to be orders of magnitude more difficult for future growth phases, future leverage phases in the future to detach. That's the ultimate problem of how we've gotten in this scenario where the whole world is one trade as it is. That's how we've gotten to this problem. When you detach the bedrock from energy and you attach it to instead debt of a promise of future payments denominated in a currency that we're going to debase every year to keep everything going up. I mean, I don't know what else to say. I think you should be buying Bitcoin. I think you should be buying more Bitcoin. And Bitcoin is going to tens of millions of dollars before this event happens, in my opinion. I think this takes, I don't think this is going to happen until the 2040s, 50s, 60s. I don't know. I think this is going to take a long time, and you got to prepare for this for taking a long time. But at the end of the day, that is the entire thesis, that we are transitioning away from a debt-based financial system into an energy-based financial system. And the reasoning for that is very simple. We are producing more goods, we're producing more commodities, and the more those we produce, the harder and harder it becomes to justify the premiums given to everything built upon a debt system. And that's a cycle that I think we'll go through. And I genuinely believe everything else is trending to zero on Bitcoin. All these things are going to fall 99% in terms of Bitcoin. It's just a matter of time. And you got to get off zero, right? Even if you have a 95% allocation to all this stuff, that's just the same trade, and only a 5% allocation to Bitcoin, that 5% is going to be worth more than 95%. It's just a matter of time. The only wrong allocation, the only foolish, idiotic allocation, in my humble opinion, obviously I would be somebody that would say go all in Bitcoin, but I can't tell you to do that. Everybody's in their own financial circumstance. But the only wrong allocation is to have a 100% exposure to this and a 0% exposure to that. You have 100% exposure to a house and 0% exposure to the insurance policy on the house. And I think that's a really big mistake. So you should get off zero and you should buy Bitcoin. That's all I have to say. Thank you for your time.